Good morning, good afternoon, good evening, one and all. This is the Smoking Barrel. I'm Rustin Edwards, based in Geneva, with my illustrious co-host, baking in the Dubai sun, Mr. Matt Stanley.
Greetings. Yeah, no, it's all right actually. Yeah, weather update. I know everyone is on the edge of their seats. It's 35 degrees, well, 36 and hot. I mean, what do you want? It's the summer in the Middle East. 2nd of June. It's June, Russ. It's bloody June
It is
already.
June. It
I mean,
is.
I know I'm getting old. I know I repeat myself and didn't mean to, but at least every day is a nice surprise. That's a great thing about getting old because you forget what happened. So it's like, oh, well, that's good. I forgot about that. My wife drives my wife mental. Anyway, enough about who's in trouble. Yeah, 2nd of June. Don't know where it's all gone. Nearly 6 months through the year. Summer holidays around the corner. And where's crude oil?
Oh,
$64.40. Where pretty much where it was last week. No.
yeah, I think it's pretty much where it is. I mean, yeah, crude is up $1.60 on the day, but I think that's part of me feels that that's gap filling that's been happening on the chart, as well as people reacting to the geopolitical risk in the market. But I would disagree that this is a reaction to OPEC bringing back just a measly, Peasly 411,000 barrels more in July.
Well, good cop, bad cop. I'm going to disagree with your disagreement. I think that the market was worried at the end of last week that OPEC would get together and bring back more oil than the rumored 411. They didn't. Look, our view as Kepler, Amina's was working really hard over the weekend. She's great, covered it every step of the way through the meeting. It's a couple of observations. Our view is that the OPEC will continue to bring back oil. They'll bring back the similar amount, another 411,000 barrels a day in August. That will mean they're 80% of the way back, bringing back the 2.2 million barrel a day voluntary cut. We're in a lower price environment than I think the majority of OPEC members would like, but more volume kind of negates the lower price. But what wasn't discussed or what didn't come out of the meeting, and let me get this verbatim, otherwise I'll get in trouble, was where are we? There we are. There we are. Um, what we see is that there wasn't a planned, where is it? Talk amongst yourselves. I still think they will repeat from August. But there was the compensation cuts, the additional compensation cuts weren't announced, right? And I think that there is probably an issue in-house. This is Matt Stanley talking, not Kepler. Don't sue me, Kepler. We had this conversation. Kazakhstan, the biggest laggards right now, they simply are not in a position to cut, to compensate for overproducing. It's a different dynamic there. And others who need to compensate, the likes of Iraq are probably the biggest ones. I'm sure that you'll see data, and they probably have lived by that promise. But Kazakhstan is a problem because of the nature and how it's made up, and the CPC pipeline. It's just very difficult. But I think the balances globally are pretty tight. Inventories are 5-year lows. The market is looking at demand. Let's not say market isn't looking demand optimistically, but less cynically as it was before, right? The market is looking at it thinking, actually, maybe it's not going to be as bad. I mean, we've got 700,000 barrels a day, roughly, of oil product demand growth. Others have got 1.3 OPEC. I think it's somewhere in the middle. But look, that's why I think the market, while we're up a buck 60 today, backwardation's strong. The dollar's weaker. So look, I mean, it seems like a good news story. More oil is a good news story, Rustin.
I hear what you're saying about stocks, but I always like to look at data because data is always a driver of anything more than anything else. And if we just take a look here at um, a bit of a chart from the US EIA,
Mm.
where we can see that total oil stocks in the United States roughly 1.6 billion barrels of oil,
A
which
lot.
you go back all the way to 1990, roughly around the same level as they were in 1990.
Yeah, but hang on,
That
hang on. Yeah, I
that is
look fine. But that's that difference between 1.5 billion and 2 billion. That's a lot of oil. That's 500 million barrels of oil. So I don't
Yeah,
think
but
that that's a
remember
right mix.
what was oh, that's a little thing called COVID.
Yeah, but it's an anomaly, right?
A little thing called COVID happened here.
Yeah, but I mean, I can't believe that was 5 years ago. I was talking to my wife about it at the weekend. That's mental. But
Yeah, it's hard to
yeah,
believe
let's
it
come.
was 5 years ago that we were all sitting in our respective flats wondering if we could go outside or not.
Right, exactly. But if you look at 2025 numbers there and you take that to the chart where it was, you're talking early 2000 stuff, so 20-year low. And, you're right, the data doesn't lie. But when you extrapolate the chart, what it looked like from then, when it was last at that low, that what was that, 2004,
Well,
up,
I mean,
up
we
to
were lower
COVID,
in
that,
2000, what
yeah,
have you.
yeah, fine. But if you look up to COVID, where the trajectory of that line is doing that, right? And then we've dipped below. So 20 years, I
But
agree.
I would also look at the relevant stocks of supply versus demand profile because to sit there and say that, oh my God, stocks are low. But if your overall oil consumption is also lower because demand destruction has happened in the gasoline and distillate sector with the advent of the EVs and better fuel efficiency, which we've talked about on many occasions, are we truly at low stock levels or are we at the right stock levels?
Uh, look,
Because to me, it's a level of what is your day coverage of demand, not so much overall stock number.
yeah, but I mean, why does it matter as such? People are
Well, it
looking at
does
what,
matter. It does
what?
matter. When people say markets are tight, oh my God, look at the inventories. They're so tight. Yet when you're sitting on, in the United States, 26 days of demand, which is a
Yeah.
high level of demand day coverage, then it's not that tight.
Well, I mean, this is what I'll do is I'll share our supply and demand model here. This is our as Kepler. This is what we've got here globally: crude and condensate, global net balances. So here we are. We are now June. We've got a deficit of 350,000 barrels a day for June, 700 for July, and similar for August. That is a seasonal thing because Europe pulling a lot of oil in over the summer, which is why markets are backwardated. But you know, this is where people are referring to. This is what people are talking about, a tight S&D balance. Market will be in deficit. That's what the market is trading against. That's why structure is reflected accordingly. Does it, when you boil the numbers down to, yes, there's still a lot of oil in storage, but it's, you can only go by the metrics. If people are going to trade against that metric 20 years ago, they're going to trade against them today, and that's how the market is sort of pricing that in. So it's yeah, it's things are looking tight, and that's why we're up $1.60. I'm not sure how the US will deal with it, if I'm brutally honest, but yeah, we'll have to wait and see what they do at the Open. But it's a Chinese holiday as well today, so perhaps there is. Some skewed trading going on. But as soon as the markets woke up this morning on the back of the OPEC news, I think if you would have seen a market that where OPEC came in over the weekend and said, actually, we're going to cut 800,000 barrels, bring back 800,000 barrels a day, I think you'd be down $3. I don't think you'd be up $1.40. So more oil back is good news, right?
Today's move up is more an overreaction to bearish news.
Yeah. I mean, look, like I said, it's not as bad as people were initially thinking it was. So we're going to stick around, the mid 60s. And I just want to put that mid 60s number into context. And I said the same thing at the beginning of May. We're in the 2nd of June now. And when we spoke at the beginning of May and it issued an episode, recorded an episode, the best way to sort of look at what's happening in oil markets is a look back at the previous month. And it's here in the UAE, it's pretty easy to sort of figure out what prices have done over the course of the month. Sure, there's volatility in between, but the fuel pricing committee of the UAE get together and decide at the last day of the month, this is what the price will be for the next month. And in June, prices were exactly the same as they were in May. And that was the same as they were in April. So it's only the second time that's happened where prices have for 3 months have maintained the same price at the same level. Last time was in January this year. That goes to show you that with all the noise, all the demand, no one buying oil anymore, and it's all bad for fossil fuels. Prices have just done that. and they're remarkably stable. And at the end of the day, that is the overarching objective of OPEC Plus is to keep prices stable. When they bring back oil, it's based on fundamentals. 411,000 barrels a day back in July. We think another 400,000 barrels back in August. I think that's been baked into the cake already. And the world is happy.
Yeah, well, I would tend to agree. I mean, I would think that at this point, at these price points at between 60 and 65, oil is fairly priced. Not much to
Yeah,
move it up, not much to move it down. And so, you get a $1.40 swing today, which might end up being a flat market by the end of the day, just as how things usually price with a lot of aggressiveness coming in from the Asian market. And you get your European and US traders come rolling in, and they'll probably take profits on whatever length they had if they were long.
yeah,
You probably have short covering going on today is probably the biggest reason why we're up because people were expecting larger oil cuts or a
yeah,
larger oil bringback, excuse me, and that did not materialize. So you do have people liquidating their short position come first thing in the morning when they get in the office. So
yeah,
I can see that's why you have a big spike. It's more probably covering than anything else because what was expected did not materialize.
yeah.
But
And
nevertheless, we're in a market that has, I would say, average demand versus supply. And if anything, we still probably have a bigger bias lower than we have an upside bias at this point in time.
yeah, look, I mean, just on
Real
that.
demand to justify higher prices.
Yeah, I think you're right. I think oil prices are in that sort of Goldilocks place, if you like. I mean, maybe not for everyone. There is not such a thing, but I think just on the demand story, you and I spoke about this before we came on today. I think oil demand is okay. I don't think it's as bad as people thought it would be, but I don't think it's as good as some people thought it would be. I think it's okay. And I just want to bring in something because we're in an environment where the markets are still trying to work out what's happening with tariffs. And just to bring that home, just uh, any locals that are listening, local to the region, local to Dubai, that was on the radio this morning. There was a lady who came on and she started to develop some new gym um, uh, wear, right? And it's manufactured in China. She looked around, there was other people, but the technology is not there, so it's got to come from China. She had deliveries in Q1, that was fine. Then she had some deliveries due in like May, and apparently it's just chaos. Tariffs, I don't think anyone yet understands the implications of tariffs, but I think that the risks associated with how chaotic things will be have been priced out, and now we're starting to feel it from an end user point of view. But when it comes to the biggest bellwether there, it's to do with China. How much oil, for the context of our poddy, like, comment, subscribe, is how much oil China are buying. Look, it's pretty tepid. We look at this is crude and condensate imports into China. You can see that all right, yeah? So where are we now? Let's go May because we're 2nd of June. So this is based on predictive numbers. We've got 9.8 million, 9.78 million barrels a day for June, but let's go to May. 9.6. Now the 3-month average is 9.7. The last time it was at this low was January, 8.7. That was very low. But I just want to go. So this is the last data for the last 18 months, and this is in total. We can split it out a bit more. But I just want to go back to all our data. Look at this chart, and I think that it's sometimes when you sort of take stock about something, you have a look at what has happened over the last, our data goes back to Jan 2013, to 12 and a half years worth of data. And this is still a 45-degree, more or less, chart upwards from
Well, you
where
you had an upward trajectory until you hit about this 11 million barrel mark, and then it plateaued. And
yeah.
now you have a downward trajectory from 2023 onward.
Well,
I
look, I
mean,
mean, here's the highest, 11.5 million barrels a day. When was that? June
yeah,
2020. So
which
that
is
would have
in the max of the COVID price collapse,
been
they
right.
imported barrels.
Exactly. So that would have been April 2020 when prices went, I think that was the 20th of April and TI prices went negative. Um,
Hmm.
But look, I mean, that's they are price reactive like that. Chinese are, but then it came off. COVID reared its head again here, reared its head again here, reared its head again
Well, I mean,
here.
I don't think that's more, that's just more China eating through the stocks that they built during the
Right.
COVID price crunch. So they
Yeah.
didn't need to import more oil. But then if you look at, so if you draw a flat line there at the 2020 level to 2023, you can say the stock's pretty much plateaued. And now from 2023, they're going down.
Well,
The
these are
imports are,
imports. You're right. Yes. If you were to put inventory levels against this, which you can do somewhere on here, um, then you'd probably see a correlation. You'd see spikes here. You'd see drawdowns here. Right. Of course. But I just this is Jan 2013, 4.5 million barrels a day. It nearly tripled in 7 years to 11.5 million barrels a day. Like I said, it's obviously extenuating circumstances during a bloody lockdown and,
yeah,
and
also,
pandemic.
but China also went through that massive growth phase where they were building refineries like they were going out of style. I
Yeah,
mean, it seemed like every 4 months there was a new 300,000 barrel per day refinery being built in China coming online.
yeah,
But now that that has finished, that is done, the demand for oil imports into China starts to drop off because they don't need that fuel. I mean, they've been doing a lot to transition away from petroleum consumption, especially for transportation fuels. And you can see that in your import numbers. I mean, from
yeah, exactly.
2023 onward, oil imports have dropped and they are
Yeah.
trending lower.
But look, I mean, well, trending lower. Look, so this
Go
is
back,
last
go
eight.
back to the prior chart, please.
Yeah, but hang on. This is 18 months. It's
Yeah.
8.7 million barrels a day here, 10.7 million barrels a day in June last year, and the 3 month average is 9.7. And that's roughly what we've got June imports being because the
And if you go
majority of
back to
stuff's
the
on the
prior
west.
chart, you can see the downward trajectory starting in 2023. From 2023, you can see that there's a downward slope.
Well, okay, let's go 2023. Okay. I mean, yeah, yeah. Okay, there
There's a
is.
downward slope.
Yeah, but I mean, you have to squint. You have to
I,
squint.
I'm, I, I'm the one who wears glasses. I can see it as clear as day.
Well, I mean, yeah, I mean, you might need to get them checked out, mate.
Take the horns off, Mr. Stanley. Please take the bull horns off. They're
I
blocking
don't
the
have them
cast.
on. I just think things. I am neutral, right? This, okay. From here,
It's a
I'm like,
downward trajectory slope from 2023 because their overall internal consumption has been dropping.
okay. I mean, right, okay, fine, slightly, but this is where I think that things are okay, right? Um, I don't think the demand is great. I don't think demand is that poor. I just think it's okay, and I think, look, you were at an industry event last week, and I think benign markets, stable petrol prices at the forecourt in the UAE, a fair reflection of where prices are trading. $64 a barrel, range bound market. As a trader, it's a nightmare because there's no margin, there's no real volatility. There's volatility intraday of like a
Uh,
dollar 50, but it's
the,
such a difficult market to trade.
the problem is that most traders most traders have is that they're bull traders. Everybody wants to see the market go up, not go down. So whenever you have a downward trending market, which we've been in a downward trending market since January, and this has more to do with just overall supply and demand versus anything else. You couple that with the political actions done by the United States and all the talks and tariffs back in May, March, and April, and it's just put a downward bias in the marketplace and makes it where you don't have a theme that's tradable at this moment in time, and therefore a lot of traders are keeping their hands off the wheels. As I like to say, they don't want to get involved because they have more to lose than more to gain. Um,
Yeah.
so therefore, you end up with markets that are kind of muddling along because there is nothing to drive the market one way or another.
Yeah. Look, I mean, and again, that's something else you and I spoke about separately is that I also see the dynamics of the market changing a little bit as well. The influx of, say, Russian traders to different places. I think it's much harder environment to trade those sanctioned barrels where the margins have historically been, difficult for people to
They're
do it.
not sanctioned barrels; they are price capped barrels.
Price cap
There's a
barrels.
distinction there.
But more and more difficult to um, get involved in it. Even if you can do it, you can do it, and it's quite easy and it's quite transparent for how people can understand to do it. But I would say the influx of traders into Dubai has dropped off. We've seen, people struggle. The Montfort refinery in Fujairah, that's been dismantled. Margins just are not there, and I hope that people are all okay, of course. But it seems to me like that has coupled itself with the rise of the NOC, the people who are optimizing their own oil, the likes of Saudi Aramco, right? Who now got huge trading ventures, always have done, but really optimizing their barrel now. ADNOX, we've got Bapco coming into the market, we've got KPC setting up a trading app. I'm just talking about the Middle East, but then you talk about your Reliance, you talk about this sophistication of the Chinese traders. When I was in Singapore 3 weeks ago, these are sophisticated, not patronizing at all, but the market kind of relied on the fact that they could be taken advantage of a little bit, and people were able to leverage it. That's not the case anymore. I think that any
Well,
opportunity where you could sell to a net importer and it would be tender stuff is being diminished year on year.
and I think you see it also when you look at the activities that are done by the trade houses, your Vitols, your Trafalgars, your Gunvors, and the like. They're
Mm,
getting more and more involved in the full oil supply chain, not just trying to rely on that space between the buyer and the seller. I mean,
yeah,
they've all started owning refining assets. You've got the current IP sale, which you have Gunvor, SOCAR,
yeah,
looking to get involved with IP refinery sale in Italy. And they're all picking up assets because I think they've all realized the money's made in owning and running the assets, not so much being there on the sidelines to trade when people have things mispriced.
yeah.
Um, and so this is just a dynamic that's going to change in the market over the next 2 or 3 years. I mean, at some point, I'm expecting to see VTOL open up the exploration company VTOL. They're going to start drilling for oil.
Well, I mean, this is the irony, isn't it? Is that there are enough people doing that if they need to get rid of their oil, then a trader like Vitol are there to help them buy it, right? I mean, you look at the Dangote refinery and, the people's naivety and perhaps arrogance that they didn't think that they would be able to diversify their crude slates, that would be reliant on historical trading methods or archaic trading methods. They're buying Algerian, they're buying Midland, they're buying Dover, they're buying, there isn't something they can't really run. And now the refinery's back up, running about 80%. It's something that I think markets were perhaps hoping more than or banking on more than ever. But it does seem right. I think we spoke about this. I wish we coined it recarbonisation. The world needs oil. It still does. Europe came out of it too quickly. BP are back in that frame now, and I think you've got the Grangemouth refinery being mothballed now. That's just an import terminal. There's the Gelsenkirchen refinery that's going to go down. There's others as well. Europe is less of a refining hub, more of an import hub, and you just get a feeling that the traders with this, you mentioned IP, that's the Italiano Petroli refinery, where the state oil company of Azerbaijan, which is SOCAR, and Gunvor are up against each other to buy that refiner. That's obviously where margins are. Europe still needs a shit ton of oil. There's no other way of putting it. And I think people came out of the fossil fuel race too early and now scrambling around to get back into it. Recarbonisation, people.
I don't know if I'd go as far as saying recarbonization. I would just say it's probably more realization that oil demand was not going to fall off a cliff, but it's going to be a slow, meandering drop off over time.
Yeah.
Because the governments in Europe and the United States were not putting their teeth behind the decarbonization efforts. I mean, they backtracked on pretty much every rule they try to throw out there to try to limit gasoline consumption and diesel consumption. But nevertheless, there is an impetus to be involved still in petroleum trade because petroleum will be around even into 2050. There will be petroleum demand
Yeah.
because again, there are those products that oil makes that other analogs have not been developed yet.
Yeah. I mean, look, so what we touched on UAE petrol prices, flat markets, OPEC bringing back more oil, market being surprised up $1.36, coming off a little bit with London waking up. Um, I want to touch on your first love, freight, shipping. I heard this morning someone interview that freight is well, shipping costs to the end user are becoming more and more expensive. Now, this is obviously probably a tariff chat, but is what's happening on containers? I mean, I know obviously
Well,
something you don't keep an
it,
eye on as much as tankers, but
it's
what's happening in containers?
it's a bit of a knock-on impact of the tariff talk because when the tariffs were initially discussed and initiated by the United States against the world, and the shotgun blast heard around the world, I'm going to call it that because that's what it was like. Try to hit everybody at the same time with the same shot. You had a basically a cessation of activity in the shipping markets. You had port delays, you had ports that were building up in empty boxes as people were finishing bringing in their last import, shipping the boxes back to port. And so you had a lot of backup that happened in the ports. And when that happens, it can usually indicate that you're going to see a spike in freight rates, which has started to happen, especially as people have said, "Oh my God, there's been a hold off on the tariffs. Let's get our stuff now before the tariffs are reactivated."
Right.
Um, to one of my favorite charts from
Yeah.
trading economics, we can see that the freight spike happened. I mean, we were trading at around 1,300 on the containerized freight index for pretty much all the tariff talk action, where it came down steadily. And then once the news on tariffs was moderated and changed, we've had this pop back up to 2072.
Wow, that's a
That there
25% increase since the 29th of May.
it is, and that is basically because there are people struggling now to find ships to move their goods, so they're willing to pay more to get their boxes on a boat before the tariff truce expires.
Do you know, I bloody hope so because my favorite Italian deli in the UAE has run out of mozzarella cheese. Oh, it's a disaster. It's a cheese disaster, people.
Well, you should learn how to make
Disaster.
it. Become self-sufficient.
Yeah, let me go and buy a
Just this
cow.
idea that there's somewhere, Mr. Stanley.
Yeah, I'll let a cow graze in my garden with no grass, in 55-degree heat. That sounds like a brilliant idea. Rustin Edwards, how to revolutionize the world. No, look, joking aside, wow, that's some spike in 3 days. Jesus, what do we do with that? Do we sell that or
Oh,
buy that?
but it's not just in 3 days. Okay, this is that chart is a week worth of data. So that's happened over the last 2 to 3 weeks. You've
Okay.
gone from the 1,200 quote up to 2,000. And that is, again, people responding to the pause in tariff activity and rushing to get a ship loaded or get their boxes loaded and get them onto the next ship to get it over before the new tariffs come back into place, or the tariff war resumes in full force.
Hmm.
So you will see that type of, because the problem is very similar to the problem we had at post COVID, when trade started to come back after COVID. You have a lot of empty boxes sitting in places. They need to get to the place where they need to be loaded. And so that takes up space on a ship. And you got people who want to move cargo before tariffs, that takes up space on a ship. So that just increases the cost to move a box across the Pacific Ocean.
Yeah, but hang on. Maersk, I'm just looking at Maersk shares here, obviously being the benchmark for container liners. Their share price was down 9% in May. So it's not reflective yet of the
Well,
performance of a
that's
container.
earnings. Yeah, and that's our earnings based on what they've had already. And the May price was dramatically impacted by the tariffs.
Right.
Because
So
remember,
this is where they're trading on the Copenhagen Stock Exchange right now. It's that marking a decrease at Danish krone 11,495 a share, down from 12,575 a couple of weeks earlier. So, yeah, I mean, I don't know. Is that what do we do with that? Is what's
well, I mean, if you look at their share price over the last month, it has gone up from a low at the end of April of 1466 to 1612 on the previous close. So it has trended higher over the last month.
okay?
Now, over the year, it's lower because it was higher in Q1 than it is today.
Yeah.
It's still trending upwards ever since the tariffs came up. Because remember, it's not that, okay, we're not going to do tariffs. It's a pause in enacting the tariffs.
And people paying what they have to just move stuff around.
Yeah, because
And
they
what
want to get their stuff moved before the real tariffs come back into play.
And what do you think happens here? People will continue to do that as long as things are ambiguous?
As long as there is no clarity on new tariffs being applied or there's legal challenges to tariffs in the United States, people will move goods to quickly try to get in front of any announcement from the Trump administration.
Interesting.
And so, yeah, container freight will remain fairly strong, I think, going for the next 6 weeks until some of these deadlines hit and either the Trump administration kicks the can further down the road to negotiate further, or they revert with some higher tariff rate, which would be hard to understand why.
Yeah, and I think then you got to come and start looking at seasonality because it's really end Q3. Well, second
Well,
last month of Q3 is when people start buying stuff for Christmas time and things like that.
that's when stores typically start stocking up for Christmas. And
Mm.
so, if these tariffs are going to be an ambiguous state, you'll see strong freight rates going into Christmas. If the tariffs do come into play, then the price of your synthetic Christmas tree will go up.
Look, people, it's maybe June. It may be the 2nd of June, but we're never too far from a conversation about Christmas. On that note, let's do it. I've got to go. 64.24 up $1.46. We are on Brent. Structure still strong. Dollar weaker. 135.49 for cable. Crack's doing well. Freight is up. Summer holidays around the corner. It should be a good Q2. Who knows?
Well, as we're coming out of Q2 going into Q3, we'll see how things actually shake out in the wash.
Sounds good.
But we'll probably be meddling along here between $60 and $65 unless there's a major change in the geopolitical framework of the world.
There you go, people. Trade on the back of that. Blame Edwards if it goes wrong. All right. No, like, comment, subscribe. Good to see you.
Like, comment, subscribe. Catch us on YouTube, Spotify, and LinkedIn. And we'll catch you all next week.
Ciao.